Welcome to the fifth episode of Ask You. As always, let's get straight into the question. Is investing in condos in Toronto no longer a viable option given the current market situation? Well, that's a great question, one that's on the minds of many buyers and investors right now. If you're wondering whether now is the time to invest or if it's best to wait, you're in the right place. In this video, I'll break down the key market data and trends you need to know and show you how to evaluate condo investments so you can make informed decisions tailored to any market condition. Whether you're a seasoned investor or just starting out, you'll leave with actionable insights that work no matter what the market looks like. Like most things in real estate, the answer really depends. What you consider viable changes based on your goals and where you are in life. For instance, someone who's 65 might approach investments more cautiously than a 30-year-old looking to build long-term wealth. So remember that viability isn't one size fits all as we dive into the details. To really answer the question, there are three key factors you need to focus on. First up is understanding the current market situation, because where prices are headed plays a huge role in your decision. I'll break down what's happening right now so you can get a clearer picture. Looking at supply, inventories dropped in August, which is typical based on historical data. However, it's starting to rise again as we enter the fall market, with sellers listing their properties after summer. I expect this trend to continue, with inventory increasing further as we approach winter. Sales numbers are down significantly compared to previous years. In fact, August saw the lowest sales in the past 8 years. With higher supply and lower demand, it's no surprise that prices are dropping. Prices have been fairly resilient, but in this scenario, it's hard to defy market forces. It's like trying to fight gravity. You simply can't. The final metric we track are days on market, which has spiked, and the list price to sales price ratio, which was under 100%, meaning listings are selling for less than the asking price. From the data, it's clear that prices are likely to keep dropping as supply outpaces demand. But here's the opportunity. With prices coming down and interest rates expected to follow, now is the time to start paying attention to the market before it heats up again. This brings us to the second key factor, interest rates. Recently, we saw a drop of 50 basis points or 0.5% from the peak. Experts are predicting further rate cuts, largely due to a slowing economy and lower inflation. These predictions have been spot on so far, so it's reasonable to expect rates to continue falling. What does that mean for you? Lower interest rates can make borrowing cheaper, boosting your cash flow in the long run. And if you want to dive deeper into interest rates, you can find it linked above or in the description below. Now, this brings us to the third and final factor, which is the specific property itself. You can't just look at the market or interest rates. You need to evaluate the numbers for the specific condo you're considering. Let's use an example. I recently sold a bachelor or a studio condo in King West, a high demand area close to a future subway station. The condo sold for $440,000, and one of its strong points is a low condo fees of only $228.16 per month, which greatly impacts cash flow. Property taxes were also low at just over $1,700 a year. This unit could rent for around $2,000 a month. I actually had an offer at that price before the seller decided to sell it instead. For this example, let's assume a 30-year mortgage with a 5.85% variable interest rate and a 20% down payment, which means you're financing 80% of the purchase price with a loan, which is typical for most investors. Now, let's see how a rate drop could impact this investment. If the rate drops by 1.5% next year to 4.35%, and then another 1% the year after, here's what changes. In year 2, even though you'll still have a negative cash flow, your payments drop to about $2,318. Your ROI improves to 3.55%. By year 3, with the additional rate drop, you'll have a positive cash flow of about $300 per month, and your ROI jumps to 7.07%. Waiting out the rate cycle can make a significant difference in your returns. This highlights how even a small decrease in rates can significantly improve your investment returns. And while we can't predict the future with 100% accuracy, these are the kinds of trends to watch when evaluating your real estate opportunities. This is why I see future growth potential as the interest rates drop, especially in downtown Toronto, where the demand is high and supply is tightening. As population growth continues, rental demand will increase, driving rents higher. Plus, the pre-construction market has slowed in the past 2.5 years due to the rising rates, leading to an eventual supply shortage. In my opinion, this is a very viable investment with strong long-term prospects. To answer your question, I believe investing in condos is still a viable option, as shown in my example. Prices are coming down along with interest rates. While rental rates may dip in the short term due to higher inventory and the slower months ahead, prices will likely remain sticky and rise in the long run, driven by population growth and limited supply. Make sure to do a thorough analysis on your property and consider what the numbers will look like 1 to 2 years from now, rather than focusing only on today. Real estate is a long-term game, so you need to think long-term. If you're a serious investor, it's smart to get ahead of the crowd now while the market is quiet and the rates are still high. Once rates drop to, say, around like 3% or so, it may be too late, as buyer demand will likely increase as the numbers start making more sense again, creating more competition. It was less than 3 years ago when people complained about how competitive the market was with so little supply. Now we have the most favorable buyer's market I've seen in the past 15 years, yet buyers are sitting on the sidelines waiting for something to happen. Now is a perfect time to get serious. Start researching the market, analyze the numbers, and take advantage of this window of opportunity while it lasts. If you're unsure about any aspect, reach out to me directly. I'm here to guide you through the process and help you make informed decisions. We don't know how long it will remain a buyer's market, but it's in the investor's best interest to buy during this phase rather than in a seller's market. One of the most important factors in investing is your acquisition price. I'd rather pay a low price with a high interest rate than a high price with a low interest rate. Rates change, but your acquisition price doesn't. Keep that in mind if you're an investor. For those of you who want to do a deep dive on how to do a market analysis, you can click up here to check out how to do that. And if you want to learn more about interest rates, you can check out the links in the description below. I also have a detailed market analysis in the links below, so you can check that out too. I hope that answers your question. And remember, if you have any other real estate related questions or need guidance, feel free to ask me, ask you. I'm here to help you make smarter, more informed investment decisions. I'll see you in the next video.